They told you the bull market was over. They told you the crash on New Year's Eve was the end. But this morning, Monday, January 5th, the world woke up to a new reality. A reality where price charts don't matter and geopolitics takes over. Look at your screen. The price of silver is trading at 75.60s. We have surged nearly $4 in a single trading session. We have erased the entire crash. We have broken the resistance. And we have entered a phase that financial historians call a melt-up. But you need to understand why this is happening. This isn't just about supply and demand anymore. This isn't just about solar panels or electric vehicles. What we are witnessing right now is the return of the war premium. Over the weekend, while the markets were closed, a geopolitical earthquake hit the newswires. Reports confirmed that the United States military has launched a strategic operation in Venezuela. The headline is regime change, but the subtext, the part that the algorithm reads, is resources. President Trump once famously said about Venezuela, "We would have had all that oil. It would have been right next door." The market remembers that quote, and the market interprets this military action not as a political maneuver, but as a resource grab. When the world's superpower mobilizes to seize the largest oil reserves on the planet, it sends a signal to every other nation. Secure your resources or lose them. This fear triggered a massive safe haven bid. Capital fled from risky assets. It fled from bonds. And it flooded into the only two assets that have no counterparty risk during a war, gold and silver. In this massive 5-part investigation, we are going to break down the perfect storm that hit the market today. We are going to analyze the three unstoppable forces, war, arbitrage, and insolvency, that converged at 8 a.m. this morning to send silver vertical. We are going to show you why the Shanghai vacuum is now pulling the price higher faster than the comics can handle. And we are going to reveal the bank trap. How the short sellers who tried to clear their books last week just got run over by a geopolitical bulldozer. The chart is green, but the reason is red alert. This is the story of the war candle. To understand the violence of today's move, you have to look at when it started. It didn't start at the New York Open. It started on Sunday night when the Globex electronic markets opened. Silver didn't tick up. It gapped up. It jumped from $71 straight to $73 in the first minute of trading. Why? Because smart money doesn't wait for the opening bell. Smart money reads the geopolitical tea leaves. When they saw the headlines out of Venezuela on Saturday, they knew what would happen on Monday. They knew that oil would spike, they knew that uncertainty would spike, and they knew that in times of war, silver acts as the poor man's gold, but with higher beta. So they placed market on open buy orders. Thousands of contracts hit the system at the same millisecond. This created a liquidity vacuum. There were no sellers. Who wants to be short silver when the US military is active? Nobody. So the price had to teleport higher to find liquidity. This gap is significant because it trapped the bears. Anyone who went home short on Friday expecting a pullback woke up on Sunday night 20% underwater on their margin. They were dead on arrival. Their forced buying, their panic covering added fuel to the fire ignited by the war news. We need to dig deeper into the Venezuela narrative. Why does a conflict in South America matter for silver? Because Venezuela is a proxy for the entire global South. It is a proxy for Mexico, for Peru, for Chile. These are the countries that produce the world's silver and copper. When the United States takes aggressive action to secure resources in one country, every other resource-rich country gets nervous. They start thinking about resource nationalism. They think if the Americans are coming for the oil, they might come for the silver next. So what do? They hoard. They restrict exports. They demand payment in gold, not dollars. The market is pricing in a future where Latin American supply chains are broken or militarized. Mexico produces 25% of the world's silver. If Mexico looks at Venezuela and decides to lock the vault to protect their national wealth, the global supply of silver drops by a quarter overnight. The price of $75 is the market trying to price in that supply shock risk. It is a risk premium. Traders are paying extra today to ensure against the possibility that they won't be able to get metal tomorrow. This is why geopolitical rallies are so violent. They aren't based on earnings reports. They are based on survival instinct. Look at gold. Gold is trading at $4,516. It is up nearly 2% today. Gold is the general in times of war. When missiles fly, gold rises. It is the oldest correlation in finance. But look at silver. Silver is up 3.5%. It is outperforming gold by almost double. Why? Because silver is a hybrid asset. It is a monetary metal, a safe haven, and an industrial metal, a strategic resource. In a war scenario, you need silver to build the weapons. We discussed this in our military crisis video. Tomahawk missiles use silver. Satellites use silver. Fighter jets use silver. So a conflict increases the industrial demand for silver. At the exact same time, it increases the monetary demand. It gets a double boost. Gold only gets the monetary boost. This is why silver is the high beta play on chaos. If the world is peaceful, silver is good. If the world is chaotic, silver is legendary. Right now, the world is chaotic and the price is reflecting that double demand. We also have to consider the buyer on the other side of this trade, the US Department of Defense. With active operations in South America, the Pentagon's consumption of material accelerates. They are not price sensitive. If they need silver zinc batteries for drones, they pay the market price. So the war news isn't just psychological, it is physical. It implies that the US government is about to enter the market with a blank check. Traders are fronta running the Pentagon. They are buying the silver today at $75 because they know the government will buy it at $100 next month to restock the arsenal. This creates a floor under the price. You're not just betting against the banks anymore. You are betting with the military-industrial complex. That is a very powerful ally to have in a bull market. The bid is backed by the printing press of the Treasury and the demand of the war machine. So the war trigger lit the fuse. But a fuse needs dynamite to create an explosion. The dynamite is in China. While the US is focused on Venezuela, China is focused on draining the COMEX. The price gap we discussed last week, the arbitrage between New York and Shanghai has not closed. In fact, it has widened. In part 2, we are going to analyze the Shanghai vacuum. We are going to look at the fact that while we are trading at $75–$60, China is trading over $80. The West is distracted by war. The East is distracted by accumulation. We are going to show you why the arbitrage bots are feasting on this spread today, forcing the US price to chase China higher. The war started the rally, but the vacuum is sustaining it. If you are watching the headlines, you are focused on Venezuela. You are watching the aircraft carriers and the oil fields. That is the loud story. It is the story that drives the algorithm and the day traders. But while the West is distracted by the drums of war, the East is quietly executing the greatest wealth transfer in financial history. There is a second force driving silver to $75–$60 today. It is not geopolitical. It is structural. It is a force so powerful that it overrides the Federal Reserve and the COMEX combined. In part 2 of this investigation, we are going to expose the Shanghai vacuum. We are going to look at the massive price discrepancy between New York and Shanghai that opened up this morning. While we are trading at $75, China is trading over $80. This 5 gap is a sucking chest wound in the Western financial system. It is draining the vaults of London and New York at a rate that is mathematically unsustainable. The war provided the spark, but China is providing the fuel. We are going to break down the mechanics of this arbitrage. We are going to show you why the metal is flowing east and why it will never come back. And we are going to explain why the US spot price is broken. It is no longer the global benchmark. It is the global discount bin. The supermarket is open and China is buying everything on the shelves. Let's look at the numbers. Let's look at the hard data from the Shanghai Gold Exchange. We received the AM fixed data from Shanghai this morning. The price of physical silver in China closed the morning session at $80.87. Now look at your screen. The COMEX price in New York is $75.60. That is a difference of 5.27. In a normal functioning market, this spread should not exist. Arbitrage traders, the sharks of the financial world, should close it instantly. They should buy in New York for $75, ship it to Shanghai, and sell it for $80. Risk-free profit. This buying in New York would push the price up. The selling in Shanghai would push the price down. They would meet in the middle, but they aren't meeting in the middle. New York is rising, but Shanghai is rising faster. The gap is widening. This tells us something critical. The hunger in China is insatiable. Even with metal flowing in, the price keeps going up. The demand is overwhelming the supply. This turns Shanghai into a magnet. It pulls the global price higher. New York has to rise. It has no choice. If New York stays at $75 while China is at $80, every single ounce of silver in the United States will be put on a plane and flown to Beijing. The COMEX vaults would hit zero in weeks. To stop the drain, the COMEX must raise its bid. This is why we are seeing a 3.5% today. It isn't just speculation. It is the US market desperately trying to prevent its inventory from being exported. Let's walk through the mechanics of this drain. Most people think silver sits in a vault and stays there, but silver flows like water. It flows downhill to the highest price. Right now, the high ground is Asia. Bullion banks and refiners are logical actors. If they have a 1,000-ounce bar in a London vault and a buyer in London offers $75 and a buyer in Shanghai offers $80, who gets the bar? Shanghai gets the bar. This means the float, the available inventory for Western investors, is vanishing. You might try to buy a bar in New York, but the dealer says, sorry, sold out. Why? Because that bar is already on a FedEx cargo plane over the Pacific Ocean. We are witnessing the detocking of the West. For 40 years, the West held the silver. Now the East holds the manufacturing base, so they need the metal. They are using their trade surplus to buy our strategic reserves. And because the paper market suppresses the price, they are buying it at a discount. This arbitrage is a machine. It runs 24/7. It does not care about sentiment, it cares about the spread. As long as that $5 gap exists, the machine will eat the comics alive. And the only way to stop the machine is for the comics price to hit 80. Why is China paying 80? Is it a bubble? No, it is industry. We have to go back to the solar panel data. China produces 80% of the world's solar panels. It is January. The new production quotas for 2026 have just kicked in. Factories in Jiangsu and Jiang provinces are ramping up production for the spring installation season. They need silver paste. They operate on inelastic demand. If a factory manager needs silver to build a panel, he pays the market price. He doesn't care if it is $70 or $80. If he doesn't buy it, the factory stops. The workers go home. The cost of failure is higher than the cost of silver. So the industrial bid in China is aggressive. They are front-running the rest of the world. They are setting the floor price at $80 because that is the clearing price for physical industry. The speculators in New York are just betting on lines on a chart. The industrialists in China are betting on survival. Survival capital always beats speculative capital. This leads us to a profound realization. The spot price you see on TV, the $75.60, it is a broken thermometer. It is supposed to measure the temperature of the global silver market, but it is only measuring the temperature of the paper market in New York. It is disconnected from the reality of the physical trade in Asia. The room is boiling, but the thermometer says it is mild. Smart investors know to look at the street price. If Shanghai is $80, the real price of silver is $80. New York is just a lagging indicator. Eventually, the paper market will snap. It will gap up to meet reality. We saw this happen in the palladium market a few years ago. The physical shortage was so acute that the price doubled in a month. Silver is setting up for the same move. The Shanghai premium is the early warning signal. It is telling you that the metal is worth more than the screen says. So when you see a green candle today, do not think, oh, silver is expensive. Think silver is still $5 cheaper than it should be. We are buying dollars for 90. So the war is driving safe haven demand. The vacuum is driving physical demand. But what about the banks? What about the entities that are short this market? They smashed the price on December 31st to clear their books. They thought they were safe, but now with the price ripping to $75.60, they are back in the trap. And this time the trap is deeper. In part 3, we are going to look at the bank trap. We are going to explain why the banks are now forced buyers. They have to cover their shorts into a rising market. We are going to analyze the short squeeze mechanics that kick in above 75. And we are going to show you why the smart money banks might actually flip long and ride the wave with us. The West is waking up to the shortage and the banks are realizing they are on the wrong side of history. We are looking at the squeeze. We have analyzed the war premium driving the safe haven bid. We have analyzed the Shanghai vacuum sucking physical metal to the east. These are the external forces. But there is an internal force, a force right here on Wall Street that is adding rocket fuel to this fire. The banks. If you remember our update from New Year's Eve, you know that the banks smashed the price to $50. They did it to clear their books. They did it to lower their systemic risk score. They thought they had won. They thought they could crash the price, take the snapshot, and then buy it back slowly in January. But they made a fatal miscalculation. They didn't count on a war in Venezuela. They didn't count on China bidding $80. Now the market has reopened and the price is $75.60. The bank sold low. Now they have to buy high. They are trapped in a position that is $5 against them on millions of ounces. In part 3 of this investigation, we are going to expose the bank trap. We are going to explain why the smart money looks incredibly stupid right now. We are going to break down the mechanics of a forced cover where banks have to buy silver not because they want to, but because their risk models demand it. And we are going to show you why the $75 breakout is the technical signal that forces the algorithms to switch from short to long. They dump paper contracts to make their notional exposure look smaller. It is a regulatory magic trick. Now you see the risk, now you don't. On Wednesday, December 31st, they executed this play perfectly. They dumped the market, they smashed silver to $70. They took the snapshot at midnight. They high-fived each other. The plan was to slowly buy back those positions over the next 2 weeks at cheap prices. But then Venezuela happened and Shanghai happened. Over the weekend, while the banks were closed, the geopolitical reality shifted. When the markets opened on Monday morning, the price wasn't $70. It was 73 and then 74 and now 75.60. The banks are offsides. They sold at the bottom. Now they have to re-establish their hedges. They have to buy back the contracts they sold to protect their physical inventory. But the price is running away from them. This turns the banks into chase buyers. They are chasing the market up, paying any price to get back in. This regulatory whiplash is a primary driver of today's vertical move. Why is $75.60 such a critical number? Because $75 was the line in the sand. It was the resistance level that held the market down for all of December. The banks built a sell wall there. They placed thousands of limit sell orders to cap the price. Today that wall was breached. When a major resistance level breaks, it triggers stop-loss orders. Short sellers who were betting on a crash had their stop sitting just above 75. As the price crossed that line, snap, the stops fired. A stop loss on a short position is a market buy order. So, the bank's own defense mechanism turned into a weapon against them. The liquidation of the shorts became the fuel for the longs.